Remember just a couple of weeks ago when mortgage rates hit a 2-year low? Well, you can absolutely forget about that because interest rates just shot up to the highest level that we've seen in 2 months. And with that, it's got me changing my thoughts on mortgage rates. In this video, I'm breaking down why that happened, what it means for buyers and sellers, and what I think is coming next. 30-year fixed rates dropped from 8% down to 6% in just over 11 months. And all of this happened even before the Fed did its rate cut. Now, this decline was largely driven by expectations of a slowing economy and a more accommodative Fed policy. And because the Fed came out with a super aggressive first move, slashing interest rates by 50 basis points in its first easing campaign in 4 years, we saw interest rates dip. And everyone got excited. And then bam, they bounced right back up. In hindsight, the rebound in rates following the Fed's announcement isn't surprising. But at the same time, how much it's moved is a bit surprising. And that's largely due to two factors. The first one being stronger than expected jobs numbers. As U.S. job creation roared in September, creating 254,000 jobs, which is up from a revised 159,000 in August, and way better than the 150,000 that the Dow Jones was expecting. At the same time, the unemployment rate fell to 4.1%, while at the same time, average hourly earnings increased 0.4%. And both of these figures were better than expectations. But the second reason that I believe interest rates shot up so much so quickly is because I believe the market actually got ahead of itself. There's actually a paradox when it comes to the Fed's transparency, and that's because they want really clear communication. They want to be as transparent as possible. But at the same time, by being completely transparent, the market can actually get ahead of itself, and that's exactly what I believe happened. Because the economy, businesses, everyone ultimately want to see lower interest rates, I think the market is reacting almost too quickly to any news that might influence the Fed's decision. For the longest time, the expectation was as inflation continued to go lower, that interest rates should in turn follow. But what we're starting to find out is the Fed is actually paying way more attention to the jobs numbers than they are inflation. And while the Fed has been very open about its plans, which is a good thing, it also means that the market is hyper-focused on the news, especially jobs data. Now here's the thing, the market has been hoping for slower job growth. But as you know, the numbers beat expectation. And this has led the market to believe that we're actually headed for that soft landing, that there's a high chance that we're not going to see that recession. And because of that, we've seen money come out of bonds and it's flowed directly into the stock market, which in turn has sent the 10-year from the lows around 3.6, 3.7 to over 4%, which is where we sit today. And at the same time, we've seen that 61% chance of a 50 basis point cut in November essentially evaporate, now showing that there's a 0% chance. In fact, there's 21% of people thinking that there's going to be no cut at all. And because of all of this, my perspective on interest rates is changing. Earlier in the year, I gave my prediction of where I thought interest rates would be by the end of the year. And for those of you out there watching and paying attention, I said that I thought interest rates would have a 5 handle on it before the end of 2024. Now understand, I didn't say they were going to be at 5%. I just said that they would have a 5 handle on it, which means they could have been at 5.9% or even 5.75%. But either way, I thought they would be lower than 6%. And for a period of time, we actually did see interest rates below 6%. There were people out there with really good credit, with really good down payment, getting interest rates in the 5s. In fact, if you had a VA or an FHA loan, you could have gotten an interest rate in the high 4% range. But here's the thing. I think that prediction of interest rates moving back into the 5% range before the end of the year is more or less gone. Unless we see significant economic news that would push them down. And quite frankly, I don't think we're going to see it in 2024. For a period of time there, I thought rates were on a steady decline. I thought we were going to continue to see lower and lower interest rates because inflation was coming down, because employment numbers were continuing to get worse. But here's the thing, now I'm not so sure. While the Fed has signaled its intentions of what they plan to do with another 50 basis points cut by the end of the year, which I think there's a high probability that they'll continue to do, I think a lot of that is already baked into the cake like we've discussed before, which leads me to believe that it's going to take a lot more than just slower inflation and moderate jobs numbers for interest rates to really change course. But there is something I want you to be aware of, and that's historically speaking, the 10-year typically drops 1.4% from the highs to where the Fed initially starts their cutting cycle. And that's essentially what we saw as the 10-year peaked just over 5%. And then we saw it fall to just over 3.6% before the Fed initiated their first cut. But here's the real kicker. The 10-year typically goes down another 1.5% by the time the Fed ends their cutting cycle, which would ultimately put the 10-year around 2.2%. And you're probably asking, well, what does that mean for mortgage rates? Well, the easiest way to figure out where mortgage rates would be at that time is to take that 10-year and add it to the spread, which is currently sitting around 2.3%, which means there's a real possibility that interest rates could fall as low as 4.5% without the spread even improving. But here's the thing, that's not going to happen tomorrow. It's not going to happen next week. It's probably not even going to happen in the next year. But if history tells us anything, it should happen by the end of their cutting cycle, which could end up getting delayed with CPI coming in higher than expected, showing the overall inflation rose by 0.2%, which was higher than the estimates of 0.1%. At the same time, the core rate also came in higher than expected, reporting at 3.3% versus 3.2% on an annualized basis. Now, the one thing to keep in mind when it comes to inflation is that shelter costs make up 45.8% of the core index. And while it did rise 0.22% last month, it actually declined to 4.85% on a year-over-year basis. Now, as we've discussed before, this is a lagging indicator, but the Fed is paying attention to it. And as it continues to slow, this will likely drag down both headline and core inflation. But remember, as I mentioned earlier, the Fed and the markets are paying way more attention to employment at the moment than they are inflation. And the reason we know this is because the 10-year shot up right after the inflation numbers were reported, but as jobless claims came in weaker than expected, the market actually took it in stride and came back down, with jobless claims rising 33,000 to 258,000, which was much higher than the estimates of 230,000. And the key thing to focus on here is those are the weakest numbers that we've seen since August of 2023. At the same time, we saw continuing claims, which measures individuals continuing to receive benefits after their initial claim, rise 42,000 to 1.861 million, which is the highest level since July and near the records that we saw back in November of 2021. But here's the thing, the market will need to see this continue. One report's not going to do it. They need to see this month over month. In fact, Logan Matashami, who is Housing Wire's chief economist and someone I follow closely, believes we need to see 323,000 on the 4-week average before we ever see any noticeable difference. But here's the thing, it does show that there's a slowdown out there happening, especially when it comes to hiring, as people are finding it harder to find a job after they lose one. And because of this, it's likely to lead to much lower employment. But unfortunately for those sitting on the sidelines, this is going to take time, especially when you have members of the Fed like Bostic saying that he's open to not moving rates at one of the last 2 meetings and that he's totally comfortable skipping a meeting if the data suggests that that's appropriate. Now, before we go any further, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on what's happening with the Fed, what's happening with the economy and mortgage rates, do me a favor and subscribe to the channel. So what does that actually mean for you as a buyer or seller out there in the current environment? Well, in my opinion, I think it means you need to remain patient. Interest rates aren't likely to drop significantly in a short period of time. But as interest rates continue to drop, you're likely to see more inventory coming to the market, which gives buyers more choices. And the primary reason I believe that is because if you look at this chart here, the magic mortgage rate tends to be somewhere between that 5 and 5.5% number, which means as interest rates move between 5 and 5.5%, you're likely to see more sellers put their homes on the market. But remember, those sellers are also buyers out there. And every 1% drop we see in mortgage rates, that adds 4 million potential home buyers to the market, which means more competition. But my advice for buyers at the moment is don't get discouraged. Instead, be prepared, stay informed, work with a trusted lender. And at the same time, sellers, it's crucial that you price your home correctly and be ready to negotiate. But this is where I'd like your thoughts. You've heard my thoughts on why I think interest rates are going to stay higher for longer. What do you think? Let me know in the comments below. If you really want to know the direction of mortgage rates, make sure you keep an eye on inflation, but pay more attention to the jobs numbers. If jobs numbers continue to come in stronger, then interest rates are likely going to move higher. But on the flip side, if we see revisions to those job numbers, if job numbers continue to disappoint and unemployment continues to go higher, then that's really the needle that's going to move mortgage rates.